Hello and welcome to Traders Corner. My name is Sumay Zaka. I'm standing in for Juliet Televi. And with me in studio is Garth McKenzie. He's, of course, the founder of that site, traderscorner.co.za. Garth, thanks for joining us. So we're starting off with the S&P 500. Year to date, it's seemingly having a good run.
Yes, that's right, Sumay. It is indeed. We always start off the show with a look at the S&P 500 just from a bigger picture perspective. The chart of the S&P 500 is up on the screen at the moment. And what you can see quite evidently here is that there's a very well-defined upward channel that is in place that has been intact since March of this year. And you can see quite clearly how the highs and lows of that channel have found support at the bottom of the channel and resistance at the upper end of the channel. Now, it has been coming off a little bit off the upper boundary of that channel recently. And as we move into October, seasonally, the market does tend to pull back a little bit into October quite often, not to say that it will do that every year, but from a seasonal perspective, we have noticed that the S&P 500 usually will correct around about, on average, 2% between a mid-September high and into an October low. So if that is to be the case again this year, then it could imply that we might actually see a move down towards the lower boundary of that channel structure for the S&P 500. What I've circled over here are gaps in the chart which have been filled. So those are upward gaps which have then been filled about a month or so later on each of these pullbacks over the last number of months. Now, there was a gap up in early September, and that gap has not yet been filled. That gap comes in at around about 24.65. So looking at the structure of the S&P 500 at the moment, it does look as if it may be rolling over a little bit in the short term, and we could be in for a fairly shallow pullback. And when I say fairly shallow, keep in mind all the pullbacks on the S&P 500 of the last 10 months or so have been very shallow. In fact, since Donald Trump won the US election in November last year, the S&P 500 has not pulled back more than 3% at all during this upward trend. So it's been in a very, very linear move to the upside, very, very shallow pullbacks. But in any case, we have an option structure intact, which is illustrated on the right-hand side of this graph over here. That is a put spread option structure. It starts to work for us below 24.90, and it makes its maximum money below 24.60. If we see the S&P 500 pulling back into that lower boundary of the channel now during October, then we'll actually stand to make fairly good money out of this trade. So we are monitoring that in the month ahead. That option structure expires on the 20th of October.
All right, so let's shift focus now to the top 40 future. What are you seeing there, specifically given that we had a future closeout last week?
That's right. We had the September futures closeout last week, Thursday, and we've now moved on to the December futures contract period. These futures work in quarters, so they expire every March, June, September, and December. So right now we're trading for the final quarter of the year. And what you can see on the chart over here is that there's actually a big gap up towards the end of that chart over there. Now, don't be fooled by that gap. It wasn't a technical breakaway gap as it might appear on that chart there. What that is actually the fact that this is just a continuous chart of the futures contract joined together. So we go from the September futures contract, then move into the December futures contract. And when you see that gap up there, as it's indicated there, it's about an 800-point premium on the December contract relative to what the September futures contract was trading at. And that is purely made up of time value, because there's a 3-month time value built into the December contract that was not into the September contract. And also there's not a lot of dividends in the final quarter of this year from heavyweight stocks in the top 40 index. So there's not much discounting done because of dividends. So hence you get that big gap to the upside, which is, as I say, don't be fooled by that gap. Nevertheless, often these gaps do actually get targeted, and it's certainly been the case today. The market is trading lower, and we've actually seen that gap being closed on the trading day today. From a trading point of view, we have a put spread option structure over here as well. This is a structure that runs out to the December futures closeout. It works for us below 49,500 and goes all the way basically down towards 45,000. We will make money. So I've put this in really as an insurance policy, knowing that I'm probably going to look to do some buying into this, into any seasonal weakness now during October, and know that I've got this option structure in the background providing me with some insurance.
All right, let's have a bit of a report back on a trade that you did on Unilever.
Yes, this is a trade that we did on our offshore account. It's in the UK. Unilever is listed in London, so it trades in pounds, and we traded this on our offshore portfolio. It was a good trade. Unfortunately, it hasn't ended on a good note for us. What I identified back in early August was the fact that the stock seemed to be forming a bull flag pattern, and it looked to be ripening for a break to the upside, and that indeed did happen. So we bought on that upside break. We went long of 140 CFDs at £43.50 with a stop loss at £42.50, and we were looking for a move up to £46 here. Now, the stock did move higher. It's been looking good for us over the last number of weeks. However, in the last 2 weeks, the pound sterling has strengthened quite significantly following some fairly strong UK inflation data. And we've seen the pound strengthening substantially against the basket of global currencies. And Unilever, being a very global company, it derives a lot of its earnings from all over the world. When those global earnings are reported back into pounds, a stronger pound actually hurts their earnings. And as a consequence of that, you actually see companies like this, their share price will come under pressure when the pound sterling is strong. And unfortunately, what that's meant is that the share price has drifted back quite sharply over the last 2 weeks. I don't like to see a winning trade turn into a loser, so typically what I'll do is move the stop loss up to my entry price once the trade is looking good and it's on its way. In this case, what that has meant is that it's actually triggered our stop loss in the sense that the price has gone back to our entry point of £43.50. So we exited at £43.50, the same price as what we went into this trade. And what that's meant is that we lost £47 because of costs and a little bit of time value associated with the CFD trade. So it's a disappointing outcome because this was looking pretty good up until 2 weeks ago. But as I said, I don't like to see a winning trade turn into a loser, so we're out of this trade now for as close as, damn it, to a break even.
Okay, so you're out of that trade. You're looking at 2 other potential buying opportunities, also international.
Correct, yes. We've got 2 stocks that we're looking at on the offshore markets. The first is Google, which everybody knows, but the actual name of this company was changed some time back to Alphabet. But it still goes by the original share code, which is GOOGL. It trades in New York on the New York Stock Exchange. You can see a pretty good, strong chart structure over there over the last 2 years or so. And what I like about this is the fact that the share price has been consolidating now for the last 4 months or so. It seems to be moving towards this uptrend support line and close to the 200-day moving average over there. I just want to zoom in a little bit more closely on this chart and show you what I'm seeing on a more shorter-term basis. You can see there's the 4-month consolidation that I refer to. Also note that there was a gap in the chart back in late April, and very often these gaps will be targeted, but they'll then provide support on a pullback. So my sense is that at around about $900 a share, there's the support offered by the gap. There's also the 200-day moving average over there, which has typically provided support for Google on pullbacks in the past. So what I'll be monitoring in the week or in the weeks ahead is a potential for a bit of a flush out down towards $900 a share. And if we see a reversal up from that area, then I would look to get long of Google. So we're going to be monitoring that quite carefully. The other one that I'm looking at is listed in London. This is Diageo. It's a company which is effectively like the holding company for a number of very popular spirits, liquor brands, which we are all familiar with. And again, a nice linear upward chart over here. You can see quite clearly a nice solid upward trend that goes back over the past 1.5 years or so. This share price had a good move up in July and August, but it appears to be consolidating at the moment. And by my recollection here, it looks as if it is beginning to pull back into the support zone offered by that upward trend, and that also corresponds with the 200-day moving average on the chart there, which is at about £23.50. And keep in mind, there's also a gap on this chart over here, and I suspect that that gap could also be targeted. So we're watching this one in the weeks ahead. If it comes back down into that £23.50 area, that's where I would look for a reversal up to potentially buy this share and then use a stop loss below the reversal low.
All right, so those are the 2 that we'll be keeping an eye on for the near term. Where are we standing with our portfolios at the moment?
Well, at the moment, the Rand portfolio is unchanged from how it looked last week. So we have two positions here at the moment in South African portfolio. The one is this December put spread structure on the top 40, which I mentioned earlier. So we paid away a premium of 1,500 Rand on that trade. That premium is gone, but if the trade does work out for us, it can make up to 13,000 Rand profit for us on a pullback in the next couple of months. And then the other one we had was the PSG group trade, which in fact is actually closed out. We lost a little bit of money there, and we reported back on that last week. So our South African portfolio is sitting with a gain of around about 7.5% for the year to date, 107,000 100,000 Rand in the portfolio there. So it's up slightly, certainly not shooting the lights out, but it's looking okay. And then our offshore portfolio, which is traded in pounds, not looking very good here, unfortunately. There's the Unilever trade, which I spoke about during the show now, where we lost £47. And then we also have a put spread structure on the S&P 500 here. And there we paid away a premium of $240, which translates into about £178 at the time we did the trade. Here we're sitting with almost minus 9% for the year to date. So offshore really hasn't gone particularly well for us. We've done a number of these put spread structures on the S&P 500 which have not worked out for us, and as a consequence we have paid away a fair amount of premium and not realized any gain on those structures. So it's disappointing, but certainly not the end of the world.
Okay, not the end of the world. Just for those viewers out there who are wanting to subscribe to your site, just give us some detail on that, please.
Yes, if you go to traderscorner.co.za, you'll go to the middle of the page there, and we actually have a free weekly email that viewers can sign up to, and it'll take you about 30 seconds to put your details in and subscribe to that, and we will then send you an email every Tuesday at lunchtime detailing what is coming up on the show for the week ahead, and give you a little bit of a heads up as to what you can expect. So any viewers that are not already subscribed to that, welcome to go there and sign up.
Are there any courses coming up?
Right now I don't have any courses scheduled at the moment. I probably will look to do a course in each of the major regions throughout as we go into the end of the year. So possibly in November I might look to run a course in Joburg, Cape Town and Durban, and I will be bringing those details to the show fairly soon.
All right, so look out for those, and that's where we'll leave things for this edition of Traders Corner. Till next time, goodbye.